Eric Robertsen is with us now, Global Head of Research at Standard Chartered Bank. He joins us from Sydney. Eric, great to see you. First of all, where do you stand on this subject of inflation making a comeback?
I think it's still a little bit of a ways away, Sri. I think, as you know, we've been in the camp of disinflation or deflation for a number of years now, and I still expect that to be the case. Now, the concern that everybody has is that with all of the monetary and fiscal stimulus that we've seen over the last 9 months, that this is going to lead to a surge in inflation. And I guess I would offer a counter argument to that, which is with all of the debt that has been issued by both governments and corporations, a significant amount of new free cash flow is going to have to be devoted to servicing that debt. And in our opinion, that remains a disinflationary impulse.
Yeah, and let me just expand on that. So in other words, Eric, the biggest risk is asset price inflation, is it? Possibly financial instability further down the line? And do you get the feeling that markets are utterly underestimating this risk moving forward?
Well, look, I would certainly agree with the statement that financial asset inflation is the more likely outcome. And as we all know, we're already seeing quite a bit of evidence of that. In terms of financial instability, I think that's probably not a risk for today, but perhaps further down the road. Most of the central bankers who are commenting publicly are saying that they'll keep policy rates extremely low, even well into the recovery. And that may be where you start to see some signs of financial instability. But I would also expect macroprudential measures to be used. You've heard some talk of that out of New Zealand, where looking at house prices will be something that factors into monetary policy. So I think central bankers are extremely sensitive to this. But as I said, I think that's a risk further down the road.
The other problem isn't everything priced perfection, Eric? Whether it's COVID vaccine, whether it's QE infinity, the US political uncertainty seems to be X'd out of the equation now. So doesn't that mean that the bar for Rally 2.0 is set quite high?
I think it depends on which markets you're looking at. If you look at some of the developed markets, especially the US, whether it's US equities or US credit, those markets have staged fairly spectacular recoveries. We're back to not only pre-COVID levels, but well above them in some cases. So in that instance, you probably have a pretty good argument for full valuations. In emerging markets, we have argued that there's still quite a bit of value to be had. EM currencies are, in some cases, still below their pre-COVID levels, so quite a bit of appreciation potential there. EM equities still trade at about a 26% valuation discount to the S&P and to their DM peers, so quite a bit of valuation narrowing to be had there as well. So I still think there's very good pockets of value. It just may not be in the developed markets.
Okay, and if you are looking for the carry, if you are looking for the yield as an income investor, can you find it in emerging market currencies, in Brazilian real, MXN, Chinese yuan?
Yeah, so look, that's a very good point. And we have argued recently in our year ahead outlook that with the improving performance of EM currencies across the board, carry and yield are going to become an increasingly important part of the income investor's portfolio. In Asia, we like Indonesia, we like India, we like Malaysia. China still offers some positive carry as well on the currency side, and the bonds trade at a historically wide spread to treasuries. Outside of Asia, Mexico is probably our top pick. Again, decent carry and also quite a good proxy for global growth and global trade at the moment.
Isn't there a risk, Eric, that we, in EM land, end up becoming victims of our own success? There are a lot of yield tourists out here. There just seems to be a lot of hot money sloshing around in the system. Aren't things looking a little bit overvalued and overdone and overcooked?
So, look, you make an interesting point, Sri, which is about the amount of money that is, to use your word, sloshing around the system. We have observed that a lot of the money that historically is in the what I would call, crossover camp is still sitting on the sidelines. We estimate that in U.S. money market funds alone, there's roughly 4 trillion of underutilized assets, which could still go into EM. An interesting statistic is that in 2020, if we look at the sort of top 7 equity markets in Asia, they saw roughly 70 billion of outflows up until about a month or so ago. And more recently, we've only seen about 15 billion of that capital come back into Asian equity markets. So I would argue, actually, there's still quite a bit of potential for capital to come into some of these markets that we've been talking about.